everyone, and welcome to our webinar today. I'm financial advisor Jake Lusher, and I'm joined by Sarah McGinnis today. Hi, Sarah. How are you?
Hi, Jake. Good to be here. Good to see you.
Good. Well, for those of you that don't know, as you're watching this, Sarah and I have actually worked together all the way since 2007 at Savant, and somehow we've stuck around for a long time. So it's a real pleasure to be presenting with you today. So today's topic is going to be the topic of financial advice and value of it. And there's been many studies that have tried to determine the value of financial advice in the past 10 years. At Savant, we really felt it was important to address how you might value financial advice based on the perspective that we've gained working with clients over the past 30 years. So to start this conversation, we first wanted to review the services advisors actually provide and how exactly different advisors are compensated. This will then lead to a better understanding of value and helping to determine if you're getting enough value relative to the fees you pay. So we'd first like to dig into today's landscape of financial services professionals. To help organize these conversations, we've laid out different advisory types along the top columns, everything from a standard brokerage arrangement on the far right to the registered investment advisor on the left. Then along the side rows are key considerations to help categorize and evaluate service. So we'd like to take a moment to define these. First, there's the fiduciary standard. Fiduciary is a legal term which defines whether an advisor works in your best interests and is legally held liable for giving advice in this manner. Financial services professionals are regulated through many different governing bodies. The main three are FINRA, the Financial Industry Regulatory Authority, Securities and Exchange Commission, or the SEC, and the Office of the Comptroller of the Currency, or the OCC. The SEC and the OCC require fiduciary advice, while FINRA only requires a suitability standard. This generally means that advice doesn't have to be in your best interest, it only needs to be suitable. Second, there's the types of compensation. Advisors can be paid in many ways: fee only and direct from clients, indirect from revenue sharing kickbacks, commissions based on product sales. Those are all really good examples of compensation in this category. And obviously, knowing how your advisor is paid is critical for you in measuring the value of advice you receive. As you might imagine, revenue sharing and commissions can generate significant conflicts of interest. Third, whether an advisor is product or advisory focused, getting to know exactly what you're buying. There's obviously a difference between products and advice, but simply stated, a product might be a single investment in your investment portfolio, whereas advice is more of a robust discussion about what exactly should be in your portfolio. So for example, how much stocks versus bonds. And then fourth and finally, internal investment costs. Unfortunately, financial services is rife with disclosures and very little transparency. Usually, your advisor has both the visible and the invisible costs, and depending on the type of advisor you hire, those invisible costs can be larger or smaller, and they're often tucked into the individual investments within your portfolio. So a careful review of these details is paramount. Now, as you can generally see in this graphic, both independent brokerage companies and national wirehouses are higher in cost, tend to be more product driven, and generally don't serve in a fiduciary capacity. Banks and registered investment advisors, or RIAs, are quite different in this comparison. And of all the types, RIAs are typically the most transparent. Anytime your advisor is only being compensated by you will lead to a much higher likelihood they are serving your best interests and helping to provide you guidance over your entire financial life.
Jake, one other thing I'd love to highlight on that slide is, a lot of consumers are starting to understand, how advisors are being paid. They're familiar with the word commission, and they know that they don't want to be paying commissions. But it's really hard when there's all of these, terms out there within the financial services space to navigate. And so one thing just to be noted here is there's something called fee only, which means the investment advisor is only being paid by their clients. There's a term called fee-based, which can be a mixture of commission type products and revenue sharing, and also an advisory type fee. And then there are commissions. So a lot of people understand that they don't want commissions, but then it's a little bit confusing with the term fee-based, where it can be a mixture of, the advisory or percentage of assets under management and the commission. So just understanding that there's that middle ground there, that if you don't want to pay commissions, the fee-based route can still have that kind of structure. So if you're trying to avoid that completely, you want to be looking for something that is considered fee only, which means that you as the client are only paying you're the only type of compensation being received, to that investment advisor.
Really great point. I'd add there too that, just in meeting with people over the years, it's often the scariest moment when they're in the chairs, sitting across the table or on a Zoom call for the first time, and they're thinking in their heads, how exactly are you being paid and what will you really be motivated by? It's no different than going to visit the doctor or a dentist for the first time. There's a lot of nerves that go into that process because there's so much trust you end up placing in that person. And so, having an advisor that's willing to have the conversation up front as to how exactly you're compensated to allow some of that scariness and the nerves that come along with, this type of service offering, having the conversation up front is super important, I found. So, now that we've had kind of a good handle on the types of wealth management service offerings available, let's really dig into how we would value financial advice. Now, so we can't obviously identify exactly how much any individual advisor can offer in terms of value, but there have been numerous studies on the value of financial advice in the industry. The first major study was done actually by the largest mutual fund manufacturer in the country, Vanguard, back in 2014. They renewed the study in 2019, and they joined other large-scale academic studies from Morningstar and Russell in the past 4 years. This topic's obviously gained significant attention nationally, and it's helped raise the level of investor knowledge, leading to better buying decisions for consumers, narrowing the field of qualified advisors because it increased those expectations on the advisors of the industry that actually remain to provide higher levels of service. This graphic is broken down into the many quantifiable, more tangible elements of measuring an advisor's value. There's portfolio construction, there's the financial planning and implementation, and then behavioral coaching. Now, each one of these areas is subtotaled into an approximate value. And in total, these three industry leaders had actually contended advisors worth anywhere between 2 and nearly 5% per year of value. Now, while not guaranteed by any means, that's obviously a significant return on investment for consumers if the advisor can actually deliver. We really feel that the most paramount within this entire list is really the planning, implementation, and the behavioral coaching aspects of financial advice. And so Sarah is really going to dig into those pieces here over the next several slides.
Jake, I think one other thing to highlight here is that, a lot of people as they come in, prospective clients, one of the first questions that I hear all the time in my practice is, what am I paying for, right? Why should I pay a fee to an investment advisor? And so looking at some of these studies and understanding all of these different aspects that can be quantified can really help, the consumer really understand what are those types of things the advisor can actually do for them, and kind of cross-referencing, is the investment advisor that I'm interviewing, are they able to implement all these things that can add value? So again, these studies allow you as a individual to look at your current situation and say, hey, is this investment advisor that I'm considering worth it? And starting to look at these tools. So one of the big areas is financial planning. And so you'll see we're going to walk through a few different scenarios here in terms of one of the bigger areas of financial planning for retirees is the distribution planning. So the studies valued this anywhere from 0% if you only have one bucket to pull from, all the way up to 1.1% per year. And so what distribution planning means is that, as an individual, you know how to save, you know how to build up this bucket of money, and you're ready to retire, or you've made the decision to retire. And now you have a lot of little decisions to make. And those decisions are, how much am I going to be spending monthly? And for that monthly budget, where am I going to be taking that money from? Essentially, how am I going to take the money back out of my investment accounts in the most tax efficient way possible? So with this distribution planning, again, we're going to walk through a few examples here. The one you see in front of you is an individual that retired in 2021. So you can see that they had wages in that year, but there was still, the rest of the year where they needed to raise money to, spend on their monthly living expenses. So the decision comes up as, should I take everything from an IRA account? Should I take everything from a taxable account? Really this all comes down to tax bracket studies. So again, working with an advisor that has a lens or a tax lens that they're looking through, and helping you make those decisions. So in this situation, again, they had room in the 22% tax bracket to actually take some of their distributions. Instead of taking the distributions into their pocket, they actually did some significant Roth conversions and lived off of taxable money for the rest of the year. As you can see, they actually had a window of opportunity before they were going to file for Social Security in 2025 to again look and do more of those Roth conversions. So it's good to not only look at these things annually, but look at a multi-year plan, because throughout retirement, you're going to have, different varying levels of cash flow. You may have increased expenses in a particular year because of a big budget item that you wanted to purchase. So, working with an advisor that can help you do those tax bracket studies, understand your situation and also understand more broadly, what are the tax rates now? Where do we anticipate them to go in the future, and help you again make the distribution decisions in the most tax efficient way possible.
Sarah, one comment I'd make here is that, as advisors, we tend to be pretty tactical and math oriented when it comes to these decisions. And it's easy for us to have these conversations. But one thing that always comes up when I'm working with clients is this idea of going from a saver all of my life to now a spender, and having to actually utilize the monies that I've saved up over my lifetime. And I think a lot of that fear comes from the lack of understanding what the plan should be of how I'm going to create a paycheck from my investment portfolio during the rest of my life. And I do agree that this process just provides obviously a better financial outcome because we can use different buckets, but I think it really gives people a plan. It gives people a sense of how best to approach the next step of now spending from something they've saved up their whole life, which on the surface seems like a really scary idea.
Absolutely. It's such a shift in mentality, and getting comfortable with the idea of spending your money and enjoying it, and understanding that you have flexibility in your plan, and that there is a plan, right? There's a plan to distribute these assets, and that you're making all of those decisions correctly, and really having that teammate to lead you through that, and look over your lifetime and think about your kids and all of those things that come into play as you're, planning your retirement years. Another example we wanted to walk through, and something that a lot of people are confronted with if they do retire before Medicare age, is making the choice to, go to the marketplace and get subsidized healthcare through the Affordable Care Act. So if you keep your income low enough, you may qualify for much less expensive health insurance. So that's the example on the right. Should I be saving money on my healthcare costs and keeping my income low during those years before I'm on Medicare? Or should I ignore those subsidies and do things like Roth conversions? And so having an advisor help you understand those decision points. Again, on the left-hand side, you're seeing somebody that took advantage of those Affordable Care Act credits, kept their overall healthcare costs low. They ignored some of maybe the tax planning opportunities that would have been available, like Roth conversions. And you can actually project over their lifetime, given, utilizing that plan, what will their end of life values look like? What will their total distribution of assets look like? How much will they have in Roth? How much will they have in pre-tax? And how much will still be available and taxable? And comparing and contrasting that to maybe a different opportunity. So all the way over on the right-hand side, looking at, let's ignore those healthcare subsidies. Let's ignore some of those upfront savings that could be presenting themselves with the Affordable Care Act. And let's take advantage of, the relatively low tax rates that we're in right now. So in this situation, using the top of the 22% bracket and, paying for private health insurance, not getting those subsidies, but essentially realizing income now while the tax brackets are low. And you can see the effect on the distribution of assets at the end of their life. You can see that because of these conversions, you have a lot more of your assets built up into the Roth bucket, which is a great thing to be able to pass on to your kids. So that's always a great conversation to have with clients, because that's a decision point too, is, who is this money aimed towards? What are the goals we have for the next generation? And you can see by actually doing those Roth conversions up to the top of the 22% bracket, you're actually adding about $200,000 of value after tax at the end of their life. And so that's a really kind of long-term planning approach that an investment advisor or tax planner can help you do, is understanding how those front-end decisions in retirement can affect those end-of-life values.
Pretty clear to me that there's obviously a return on investment when you help enlist the services of someone to help navigate some of these decisions. But once you get to these stages too, I also think about kind of the return on time, right? When we think about another quantifiable element of the value of advice, time is a big part of that. And I know the behavior aspect it gets looped into this as well.
Yep, the behavioral coaching is an aspect that we saw throughout all of the studies. This is one of the biggest percentages you'll see across the studies, anywhere from 0.5% up to over 2% per year is where they value the behavioral coaching aspect of it. And the reality is that, saving money and spending money and staying the course, those are all emotional decisions. It's all things that you can rely on another person to help you, kind of lead you through that path. Somebody that knows the statistics, knows your financial plan, and can help you stay the course. Because the reality is, people left to their own devices, they tend to like the idea of trying to time the market. They get scared when, there's somebody on the news saying that this is a new market cycle and we're really going to see a drawdown. It's hard to ignore those things, on your own. It's hard to ignore friends and family talking about a fund that they picked that, did really well. It's hard to ignore when you hear markets are hitting all-time highs, but you're sitting on some cash and you don't know when to invest it. Those are all timing decisions and investment decisions that having somebody, on your team, again, that knows your financial picture, knows what your long-term financial plan is, that can help you make those right decisions time and time again. That's, again, just another aspect that is quantifiable. Having somebody help you stay the course throughout market volatility, which is something that as an investor, you're always going to have to confront. So again, having somebody that can lead you through that is a place that an advisor can add a lot of value.
I've certainly been part of several situations over the years where, one mistake can obviously erode kind of a lifetime of value. And individual consumers are no different than, in some cases, fund managers that are attempting some of these same considerations where one mistake can erode, 10 years worth of returns from an individual investment portfolio. So it's, the behavioral coaching aspect is quite the big deal. I would agree. The other piece that I think comes up sometimes, but I don't think is quantified by the studies very well, and it would be difficult to do so, of course, is this idea that your time is important as well. And I don't think anyone expects an individual consumer to track time that they're spending while they're self-advising, but it can take a lot of effort, especially compared to what an advisor might spend making similar evaluations. So we wanted to point out a few of these relevant examples for considerations. Number one is income tax and estate tax law changes. Just in the last 5 years, there have been at least 4 major pieces of legislation passed or proposed. There was the Tax Cuts and Jobs Act back in 2017, the Secure Act in 2019, the CARES Act in March 2020, and most recently, the Build Back Better proposal. Now, those 4 accounted for more than 3,000 pages of law that needed to be vetted or interpreted and perhaps planned for. That's a significant amount of time for any consumer to spend to stay current with how laws may impact major decisions for a personal plan. And similar, Sarah, to what you were saying, staying current with market trends, especially when you're hearing some of the buzz from friends and family. Seemingly every day there's a new market, a new product, innovation in financial services. And I guess it doesn't mean that every new option gets added to a typical portfolio, but it does mean that a changing market warrants a review process to see if updates are needed. Should you have Bitcoin or Ethereum in your portfolio, for example? And since predicting days ahead, months, and years is nearly impossible, having a longer-term perspective is important with helping to specifically shape and adapt portfolios. And it takes a lot of time for professionals to vet these options. Time most consumers aren't really willing to spend because, quite frankly, they'd rather be traveling, enjoying their life, hobbies, grandkids, other things that are more interesting than spending time looking, at the computer. And finally, administering the estate of a loved one. And I can't underscore this enough, but financial services, legal services really don't make this easy. Grief is already a really difficult journey and one that is quite unpredictable. And trying to navigate that while determining if other things like income tax returns need to be prepared, or if a trust needs to be interpreted properly, or how monies might ultimately get to the next generation can be really tiring and burdensome without, enlisting the help. And this process from a timing perspective can take weeks and sometimes months. So it can be quite difficult to go through that all at the same time as grief, of course. Finally, when we really think about the tangible pieces, there's also the intangible pieces, things you really can't measure, But we know that from an advisor perspective that these are the main reasons consumers enlist the help of qualified advice. Advisors that maintain an open door policy to work through critical events, such as any children facing hardship or divorce between spouses, can really be priceless. Just in the case of divorce, you may only go through one divorce in your lifetime, but there's a good chance your advisor's seen it many times and can help provide some wisdom and counseling to that process, coordinating with other attorneys or perhaps better outcomes. Advisors also spend a lot of time getting to know you, understanding what your priorities are, your values for your family, how those align with your financial plan and impact the behaviors that you have or the choices that you make, and can serve as consistent voice and accountability partner for any major decisions you will make. And really, this leads to a higher level of confidence and clarity in the future. And I think what we all strive for, of course, peace of mind. So this really concludes our summary of all the intangible and the tangible ways you can measure the value of financial advice. I really hope this helps arm you with data to make good decisions about any hiring decision you have made or you're looking to make in the future. And I'd like to pass it back to you, Sarah, just to help outline a tool that Savant has to bring the value conversation to life a little bit differently.
Thanks. So this tool that Jake alluded to, we call it our Savant investment analysis. And what we found is that so many people struggle to understand, what their overall picture looks like today. It's very common for people to have, old 401ks, or they may have an investment advisor managing a particular portion of their assets, but their spouse has assets somewhere else. And so they have a really hard time understanding, what does their overall financial picture look like? What even is my asset allocation? What is my mixture of stocks to bonds that I have for my family? And, really understanding what are the costs that I'm paying. We talked about, the variety of ways in which an investment advisor can get paid. There can be commissions, and without knowing all the vernacular and the terms associated with the financial services space, it's hard to understand that. And so what this tool allows us to do is look at, all of your accounts, your entire situation, and give you a summarized viewpoint of what mixture do I have of stocks and bonds? How much am I paying for my current advice? Whether you're, maybe you're doing it yourself and you have lower costs, that allows you to then evaluate based on those studies we talked about today. Are there things that maybe I'm not doing that an investment advisor could help me do? And is it worth, paying for that advice to get it? Or I am working with an investment advisor. I don't know how much I'm paying them. I'd like to see that data and then be able to cross-reference again some of these studies and say, is that investment advisor adding these, various levels of value to me? Do I feel like I'm getting actual value for what I'm paying for? So this tool arms you with more information, and that's really the whole point of it, is to give you information so you can really understand what your current situation is and give you that information to evaluate, whether it makes sense to do something differently.
And I think this, one of the things that's important about this tool as well is, what the graphic is really showing. So we all go through life with a default financial plan, whether we have one or not. We have one because of the circumstances that we've been through. So collecting various assets over time, having accounts that might be scattered. Regardless, you think about being on a road trip and you stop at the rest stop, there's always going to be the map at the rest stop that says right at where you are here point, right? And you know where you want to get to, but you don't know exactly how to get there. And the tool helps to bring to light exactly where you are from a financial perspective when you look at all the different kinds of accounts. And it really helps to plot a path forward past the point of understanding what you're paying and really helping to bring to light also the value end of things that you're getting from an advisory perspective. So having a good understanding of what your default plan is and how you have a best path forward and knowing which roads you can ultimately take is a big part of this journey.
And what the other thing that it highlights, again, when you show, what is the mixture of stocks and bonds you have, sometimes that can be surprising to individuals. They don't realize that with their disparate accounts, maybe the allocation that they've been running for the past 5 years is not what they thought, or is not something that they feel like actually aligns with what, they would want for their financial plan. And so getting, again, that information so that you fully understand where you're at today, and then you can better evaluate whether that is appropriate for your situation.
The planning implementation, right? It's the idea of goals and values being aligned with your financial position, and having those two come together is obviously quite powerful when it comes to the value of financial advice that you receive. But this has been a great evaluation, Sarah. Thanks so much for going through obviously the outline here, but more into the planning and implementation phases as well of financial advice. Really appreciate your partnership today.
Yeah, it was great to be a part of, and hopefully everyone, found value in the time that you spent learning about this today. And we really appreciate you joining us.
Thanks.